The ESG 85% Progressive Protection Bond. The protection bond, or the product, is an open-ended structured note linked to an ESG multi-asset fund index. The product offers exposure to this index alongside a protection mechanism, offering a minimum repayment of 85% of the invested capital on any day during its life. This capital protection level evolves over time and will increase as the product's value increases. How does the product work? Investors will purchase units of the protective bond or the product, which tracks the value of the reference index. There are two key building blocks that determine the value of the reference index: the risky asset and the protection feature. The joint value of these two building blocks derives the overall value of the product. Let's take a look at the risky asset. The risky asset, which will generate the performance of the product, is an ESG multi-asset fund index that consists of an equity fund and a bond fund. Both funds follow a sustainable investment approach, taking ESG factors into account when selecting their components. It is called the SGI Custom Dynamic ESG Allocation Index. In order to reduce the risk of large price drops, a risk control mechanism is added to the multi-asset fund index in order to maintain its volatility close to 6%. This is achieved by changing the exposure of the index to the equity fund or bond fund. When the equity fund volatility is below 6%, exposure to the equity fund can increase up to 100%. When the equity fund's volatility increases above 6%, the index decreases its exposure to the equity fund below 100% and increases its exposure to the bond fund. As a downside, when the exposure to the equity fund is reduced, the index could underperform the equity fund in case of a strong rebound in equity markets. The index may occasionally be partially invested in cash when the volatility of the bond fund is also above 6%. Now, let's look at the protection feature. The protection feature is designed to set a minimum value for the product. This will be achieved via a look-back put option with an initial maturity of 3 years. The put option is automatically renewed when it matures, or once a new maximum level is reached. The 3-year look-back put option allows the product time to recover from any drawdowns in the market asset. However, the product can be closed at any time by the issuer. For instance, if the look-back put option becomes too expensive and cannot be renewed. The protection level is equal to 85% of the product's maximum value reached on any day. Therefore, as the value of the product rises, so too does the protection level. Let's look at some examples. Scenario 1, the bullish scenario. As we can see from the graph, as the value of the risky asset, which is shown in blue, increases, the product's value, which is shown in red, also increases. From an initial value of 100%, the product value reaches 120% by day 3. The protection level therefore increases to 102%. The product invests in a new look-back put option for a further 3 years. At the end of day 6, the product's value increases to 140. The protection level therefore increases to 119%. The product invests in a new look-back put option for a further 3 years. The V-shaped scenario. The product starts with an initial value of 100%. At the end of month 1, its value increases to 120%. And the protection level therefore increases to 102%. The product invests in a new look-back put option for a further 3 years. Thereafter, the value of the product falls in line with the value of the risky asset, however is floored at the protection level. When the risky asset rebounds, so too does the value of the product, locking in a new maximum level in month 10. The product invests in a new look-back put option for a further 3 years. Scenario 3, the monetization scenario. In this scenario, the risky asset falls significantly, and no new maximum value is generated by the product. At the end of the first 3-year period, it becomes unfeasible to invest in a new 3-year put option. In cases such as this, the product can invest in shorter maturity put options, as short as 1 month. However, this is also not feasible in this example. The product is terminated. This is known as monetization. The investor will simply receive back the value of the product, which is floored at 85% of its initial value. Historical performance. Let's see how the product might have performed in the past. This graph highlights the performance of the product versus the risky asset and the protection level over time. Key highlights and risks. The product provides exposure to an ESG multi-asset fund index whilst setting a minimum protected value. The protection level will increase as the product's value increases. This does, however, mean that there is a risk of capital loss of up to 15% with this product. The product can be bought and sold daily by clients and can also be terminated daily by the issuer. Investors should be aware they may face a number of risks, including monetization risk, credit risk, market risk, inflation risk, and liquidity risk, and should read the full product brochure for a definitive list of risk factors.